Hey traders, this is Ron at Market Tamer. Happy Tuesday. Hope you had a great day. As always, everything in this presentation is for educational purposes only. We'll lead out here with the S&P ETF, the spiders. SPY was up about a 0.25% today. Oil rolled over, which we're going to get to in a minute. But even with oil's spike yesterday, the S&P, like I said, didn't do much to the downside at all. And today it's right back up testing those all-time highs. Here's the Dow, the Diamonds, ETF, DIA. Similar situation, held the 8-day in blue. If we take a look at the Qs, they were up almost 0.5%, and then here's the Russell 2000. They were actually down just a teeny bit, but they had a nice day yesterday when the market was actually down. Now, if we go to the headline yesterday where all the pundits were falling all over themselves as if the world was going to end again, oil up, what's that going to do to the overall market? Well, there were reports out today that Saudi Arabia's going to be back at full capacity here, maybe in as little as 2 weeks or something. So much for, oil going to the moon. So what happened after the exuberance yesterday? I'm going to say it again. If the reports that I read were right, they were talking about, half of Saudi Arabia is going to be down, but it's only 5% of the supply. So look what happens today. We have a gap up, and then it just sells right off. Bearish engulfing, even bigger volume than the day before. If I was an oil bull, it looks like you just lost all your edge. Now I'm going to go to some individual charts here and just highlight some areas to watch on some different stocks, but that's huge. Bearish engulfing, previous body, base body candle, bigger volume. There's always the possibility, if I zoom back out here, it can come back, test, try to fill the gap, and then push higher. Still possible, but so far based on the price action, it's bearish. We'll see how tomorrow goes, and I'll keep covering it over the next couple days. So let's take a look at some of these oil stocks. Here's Continental Resources, CLR. It didn't bearish engulf, but look at those twin oak trees. Hit the big move up. I said to you guys, since we're so close to the 200-day, probably rather get above there, right? Well, it didn't happen. Gap lower, closed lower. We did come back and test the 50-day. Now, this thing could still bounce and push higher. It could still be bullish, but here's the thing. If this stock would close below the 50-day and the 20-day, the bulls would have lost all of their edge. This could have been a one-day wonder type situation. If we go to APA, which is Apache, again, I said watch the 200-day because it also coincides with these previous highs, right? We gave it back. Frankly, I think if we even closed below yesterday's intraday low, and if you look at that, it looks like the intraday low was 25.85, 17 cents away. That's bearish. Gap fills the target. Again, I would watch the 50-day and the 20-day. We close below both of those. The bulls lose their edge. I mean, maybe this is going to come down here, hit the moving averages right there, and then bounce higher. It's always possible. Could just be a gap fill effect, but on what news, on what fundamental basis would be the question. Here is CRC. This one, it's an inside day. Volume's pretty high. It held up better. I mean, this one's target would have been the 200-day moving average. If it gets below the 50, that's a bad sign. Then if it loses the 20, again, it would go right back to the bears. Here's Whiting, a WLL. See how it stopped at the 50-day, and I said, ideally you want to see it above it? Couldn't do it. But it basically was contained into yesterday's range from the market open. Here, if it gets below the red line, which is the 20-day, I would then say the bulls have lost their edge. So if it gets above the 50, target gap fill all the way up into the 17 area. This one could be interesting from a distance perspective. There's a lot of room here to the upside, so we'll keep an eye on that one. Had some questions about KHC. I keep following this one. This is one of the Buffett stocks, Kraft Heinz. If you go back, you can see the fall from grace has been almost GE-like. We're not quite there, but this was at 90 bucks in July of 17. Then in July of 18, it's at 60. Now it's below 30. It's had a nice little rally, but today it lost the 50-day. Big volume. This could be creating a cup and handle. There's the cup. Here's potentially a little bit of a handle, but it would still need to take out the high just from yesterday, and that's right around 29, call it 30 bucks. If it gets back above 30, could be a cup and handle pattern, could be interesting. But now that it lost the 50, it's starting to lose its upward momentum here. This goes back into a neutral camp. And if it falls below the red line, the 20-day, that's flat out back to bearish. Fedex is down after hours. It was around the 157 area. I'm doing this video a little after 5 o'clock Eastern. 157 is going to put us right, you can see my little mousey right around there. So that's below the 50-day in orange, the institutional moving average, 20-day in red. It goes right back to being bearish. So if it opens up here tomorrow morning and then closes below all these two moving averages, the bears are back in charge. If anything, we could start going into a big box trading range maybe. But isn't it funny? I mean, isn't it interesting how the stock rallied right up to the 200-day, really couldn't stay above it. Earnings comes out, and then boom, it's all the way right back down there. And here's a stock to keep on your watch list. This is Kellogg. It may not look like a whole lot right now, but if I zoom out and show you some context, this stock was, up above 85 bucks. Again, July, this was 2016. Then if I take it into here, this was October of just a year ago. You're talking it was up near 80 bucks or 75 bucks a share. Well, it went down below 50s, as you can see. But look what's happening here. Big volume spike, consolidation, higher lows, horizontal highs, an ascending triangle, pretty much a close, and we could even say 64.75. We're almost there, but 64.75, 65 bucks, target would be all the way up here. This is, to me, very intriguing from the sense that we have a big volume spike, right? Big pop, and then the volume is now starting to pull back a little bit. The reds are the sells, the down days, the blacks are the up days, but it's sort of consolidating, waiting. If we get a pop higher and the volume increases, that further validates the technical pattern. So we'll keep an eye on Kellogg's. So folks, that's it. Nice sort of short video tonight. Oil's coming back down. Markets are still holding up. Doesn't really care what oil's going to do, it seems. And bulls still have the edge on the daily charts. I wish you guys all the best, and I'll be back with you in tomorrow's video. Take care.